month in review, a week in review, and all seems to kind of pile into the one idea. But nonetheless, a quarter that probably none of us obviously really expected, although we did have some warning signs of all things Ukraine early in the quarter. But nonetheless, the idea that it would never happen seemed to be the dominant narrative rather than it would happen, and inevitably it did, and everything else moved from there. Let's welcome first Sunday of the month, Mike Muller, head of Vitol in Asia. Mike, nice to have you back. You're earning your big bucks now, I'd say. How are you reading the markets at the end of the quarter? What would be your kind of summary of quarter review, quarter behind us?
Yes, I was just looking. We started the quarter at $78 Brent. It seems that seems a long distant memory, of course. It was again another eventful week when the shift of attention definitely swung towards concerns on the demand side, and the very big numbers put out in terms of the Biden administration's resolve to give a big political message by way of an additional SPR release of 180 million barrels. And whilst there's no historic precedent of oil ever being released at a pace that the Biden administration says they want to release it, it is nonetheless a very big number, and that served the purpose as intended, I guess. But on the other side of the world, we have over here in China, lockdowns of the western half of Shanghai in force right now. And the case count in China is, by Chinese standards, a very high number. By global standards, it's negligible, of course. But they really want to eradicate this. And I think whilst the experts in the East believe that China will stay on top of the pandemic issues, I don't think financial markets in the West have quite the same view. So a combination of those two things really rubbed out any concerns over supply shortages in terms of losses out of Russia and other potential concerns on flat price, which therefore gave the markets reason to sell off $10 a barrel on Monday from 119 to 109 or thereabouts. And then on Tuesday, we rose to 115. This is all Brent, and then finished at 105. And of course, in the final trading day of the week on April the 1st, we switched to the next nearby month because May Brent went off the screen, and June ended as low as 102. So there's one of your headlines, biggest ever sell-off in a week from 119 to 102 or thereabouts. WTI is open now trading at 99.20 something. So that puts Brent more like maybe 104, 105, I guess. But it remains to be seen what the WTI Brent does. But yes, it's a week when the market decided that lower was right. And of course, the other thing that people are talking about a lot is the impact on demand of the various recessionary threats and inflationary threats that we're seeing. And on that note, I'll hand back.
Yeah, Mike, sorry, the line dropped on me there. I just wanted to quickly follow up. I mean, of surprises of the quarter, I would have to say the surprise of the quarter to me is that oil prices are not really that high from the relative sense of the context. Two of the world's two biggest oil exporters caught in conflict, whether it be the Saudis with the Yemen challenge, which obviously is increasingly becoming very apparent, and of course a major war in the Ukraine. And yet, while the initial spike in oil prices, ultimately they've settled down, and from a sort of historical comparison to 2010 to 14 or any other period of dramatic comparable in history, you'd have to say at 100 to 110, it's fairly calm. Your thoughts? Volatile but calm.
Yes, just to answer quickly, I think in any other time, the attacks by the Houthis, where they successfully managed to hit some oil storage infrastructure close to Jeddah, where the Formula One race happened to be happening the next day, would have been top news, but it didn't even make the front page given everything else that's going on in the world. You're quite right. I think there is a large number of people that do feel that oil prices could be higher, considering the current risk of disruption to supplies from Russia due to sanctions. But people are still lost figuring out those numbers. I mean, the big fundamental stock draw hasn't changed. OPEC, once again, met for a very short period. It wasn't 13 minutes, it was maybe half an hour this time round, and decided to effectively roll over with a figure of 0.4 million barrels per day or so. And as such, the underlying stock draw in the market is still intact, minus, of course, the impact of COVID on China, minus the impact of what are higher than recent prices on demand, and a certain amount of rationing behavior that's going on in various parts of the world. So I would agree that given the entire price set out there, if you take a view that we're going to lose 1, 2, 3 million barrels a day of oil supply coming out of Russia, that $102, or let's just look at the number we can see in print, the $99.27 I'm seeing on WTI, does feel cheaper than most would have predicted. Yes.
Let's welcome, obviously, our Sunday morning regular commentator, Christoph Ruhl. Christoph, sort of quarter in review, again, similar point to you and your thoughts on it. I think up there in the top 5 surprises of the first quarter of 2022 is the fact that the ruble did a V dive, but has recovered right back to where it started from. Your thoughts?
No, I don't think that's a surprise. But first of all, Ramadan Kareem to everyone. Secondly, Jean, I'm disappointed. How often did we argue every Sunday after Sunday? I said, this is overblown, this oil price fear, this oil price rally. And so not all of us are shocked and horrified that the oil price is so low, but it was to be expected. There is still some breathing room. So if I go back and take stock, I was thinking about this. Some of these things fall into place quite nicely if you take the quarterly or the monthly or the weekly view and you do it systematically. Then, of course, the first question is what happens in the war theater. And it's true what you said. Most of us were certainly surprised by the invasion. I mean, I was. But what most have said before and after the invasion is that this will boil down into some sort of frozen, protracted, long-term conflict where Russia tries at a minimum to get Lugansk and the Donetsk, these two provinces, as a buffer between them and the Western Ukraine. That seems to materialize now. So that seems to be the line of retreat. And of course, Ukraine is not willing to give it up. So very hard to see a solution other than a long, drawn-out conflict, including one of the things which is I think, underestimated often in the press is these refugees. They're not just a human tragedy, of course they are, but there's also, this is an ethnically motivated campaign, and there's always in these campaigns some ethnic cleansing. And I bet you there are some people gleefully rubbing their hands in Moscow about all these people leaving these provinces. And you have those who like Russia going to Russia and those who like the Ukraine going to the Ukraine. And I have my own guess over who will be allowed back and what this will do to referendums down the road and to the Ukrainian intention to launch a guerrilla war. If there's only Russian-friendly population left, you can't really do that. So that seems to the direction it goes. The impact on the economy surrounding it, there's a negative impact everywhere, I guess, but it's in particular, of course, what happens in China. And this lockdown is also something which has been sort of early recognized by many, including the prediction that it would not be removed before the Party Congress in October, November, which will confirm Xi in his third term, making him sort of the only one after Mao who has accomplished that. My guess is still that what we will see also in the summer is a very massive fiscal and monetary stimulus in China. This seems to be the only way out for them to avoid the economy sliding into a lower growth mode. And it's very hard to cure that with the traditional more roads, more hard stuff infrastructure. So they would have to spend some serious money also on boosting consumer behavior and allowing people to move and to travel and all of that. That would have then positive impact on oil demand.
Before we just get into China, could I just like to come back to the point of the ruble? Is not a surprise, because to me, I think that's quite a fundamental issue. Ultimately, there is now a division within Europe emerging that those in the East, the Central European countries, identified that the ruble recovery indicates sanctions aren't working. And so the West needs to take much more dramatic steps in order to achieve the goal of essentially collapsing the Russian economy and hence their retreat.
No, I think this is rhetoric. They want more sanctions for political reasons, for historical reasons, for maybe all the right reasons. And they use the fact that the ruble is back to where it was before as an argument. But what has happened is Russia has a very experienced central bank president, very good. And already in 2014, she earned the trust, so that Putin, different from Erdogan, does sign off on what his economists and the Ministry of Finance and the central bank do, provided they follow the political guidelines. Here, the political guideline in 14 was to protect against sanctions and the declining oil price. They got hit by this double whammy. And Elvira Nabiullina raised interest rates at some point to above 200%. So they gave up the old policy of a fixed exchange rate. They gave up on throwing more money into stabilizing the ruble in situations like that. They let the ruble slide, let the ruble float, and they relied on very high interest rates to stabilize the ruble. This is now very similar to what they did after these sanctions. They did two things. They imposed very harsh and very effective capital controls, unwillingly, of course, helped by the West freezing all these assets and blocking the trading channels. And so there's no dollar leaving Russia now without great difficulties, maybe in a suitcase, but not through the banking system. And they doubled interest rates to 20%, so making it sort of attractive for the people to hold ruble. And they opened all bank accounts on a Sunday at the beginning, trying to prevent a panic. That succeeded. There was no run on the banks. It became attractive for 20% and 5, 6, 7% inflation to hold ruble and leave it in the account. And the currency controls the capital controls are so draconian, including closing the market for a month, that really very, very little leakage of the remaining hard currency occurred. And this is why the ruble sort of artificially dragged back to where it was before, because it cannot, there's no capital flight. They eliminated that. And so that's it's a success for maintaining monetary stability, but it can, of course, not hide the fact that in an economy with low foreign capital and with everybody leaving in terms of companies and with interest rates twice as high as they were a month ago, this economy is going to suffer, and estimates are anywhere around 12 to 15% decline this year, as opposed to the growth they had before.
Mike, the first quarter, the last month, the last week, perhaps even, seemed to be a battle between concerns about demand destruction versus concerns about supply shortage. Where do you think, Mike, we end the first quarter, with those two competing narratives as you sit at your desk every day to put some dollars on the line, so to speak? Are we in a demand destruction concerned weighted market, or are we still, and obviously from the US government point of view, it's a supply shortage one, because they've just announced a bionic 180 million barrels of SPR release?
Bionic. Yes, Sean, and a lot of the numbers are still rather ill-defined. So the big headline number, of course, is how much supply loss will there be due to official and self-imposed sanctions on supplies of Russian oil. And depending on which consultant, which expert you talk to, you're getting numbers somewhere north of 2 million barrels per day, perhaps, for the latter half of Q2 and into Q3. On top of that, there was a global stock draw that people were predicting on the basis that OPEC Plus continued to hold their line, not least because there's very little extra production available out of anywhere other than core OPEC these days. So that makes it 2 point something plus whatever shortfall there was arising from that. So where do we get that volume back? Well, everyone was expecting a return of Iranian supplies. I think nobody believes that's going to happen in Q2, and it looks much less likely than it did a few weeks back for various reasons. So that's still a zero. And it's quite important because the Iranians do have a lot of floating inventory which is available to market immediately. Then we're given the SPR. Despite the big numbers, the Americans have essentially now signaled releases of 50, then 30, then 180 million barrels. That takes them right down to their 90-day mandatory stock holding, if you consider their net imports about 3.5 or thereabouts million barrels per day. So they need to stop at about 300 million barrels, otherwise they're below the IEA minimum. And the rate at which they can be released, let's just assume it's 1 million barrels a day, even though many experts struggle to see how that would be the case, because otherwise the releases that have taken place already in a strongly backward market would have seen the recipients of those SPR volumes draw down a lot harder. But let's give it 1 million anyway and include the European release in that. So you're from a loss of 2 point something, rounded up to 3, you've got 1 back from the SPRs. For the market to trade down as it has done, that's telling you that the market is expecting a demand loss, which is the solver for the rest of this, or a production increase from places like US shale of more than 2 million barrels per day in order for that picture to go into surplus and no longer running down, no longer tearing stocks. And that's a pretty big number. So where do you get that 2 million barrels per day? I'm just rounding now. demand loss from? Well, there are parts of the world where rationing behaviors have already been in place. I mean, people have been balking at the high cost of natural gas for power generation, witness the high cost of coal, and in some cases, the decision to even start rationing and having rolling blackouts in various South Asian economies, for example. That's demand loss, right? We have evidence of people queuing for fuel in places like Southern Asia, but also in places like Eastern Africa. And again, you have consumer behavior being influenced in some way by Western European governments encouraging people to start thinking about some sort of rationing mindset. And there's some pretty big numbers available if everyone chooses to carpool or not drive to work 3 days a week, or observe speed limits or whatever it might be, right? But it's still a pretty big number to get to. So the rest then has to be people's estimate of how much demand has been impacted in China. We already had in the price and in everyone's reckoning, everyone's balances, more than a week ago, the fact that domestic aviation demand for jet fuel in China was down to peak pandemic levels. So nobody's flying in China, right? And of course, the Chinese international
nobody's even driving, I think.
Nobody's driving either, and these are not big numbers. You know?
In Shanghai, yes.
Rolling blackouts, this doesn't affect oil. People being rationed, that happens in the UK. We don't need to go to Africa because of Brexit. And I think when you look at the demand destruction which is going on, including in China, and when you look at the expected demand increases for the year, at least by EIA, then there's no surprise here. It's not an immediate danger level or crisis level. We had, when you adjust for...
Sorry, Christoph, what's not immediate crisis level? Demand destruction?
For oil prices to become dangerous.
Oh, right.
So that they would damage the economy. That's what it's all about. We don't care about high or low oil prices, only if they damage the economy are they of interest, right? Outside people who make money with it.
Yeah.
And what I'm trying to say is when you look at the... when you adjust for inflation and efficiency improvements, then the oil prices, which we had between 2011 and 2013, 3 years, very stable, very high prices in nominal terms of 111 on average, translate in today's terms to about 150. That's a far cry from where we are today. And I think the other thing which is different from, which we have to keep in mind, is the nature of these energy market sanctions. So it used to be in or out. You have the sanctions against Iran, and if you wouldn't comply, you got secondary sanctions slapped on you by the US, and that's what made people, comply more or less. Now it's entirely voluntary. You have people who don't take Russian oil, and people who do take Russian oil, and people who take less Russian oil, and nobody gets punished for all of that. And this kind of voluntary, this flexibility you have there seems to be much better at adapting and keeping price increases from sanction policies under control than the kind of harsh line which we followed before. So it's a much more flexible. Sorry.
I just wanted to get Mike's view on some of the logistic challenges here as well. Mike, we have a story in the Digest today about ship fuel suppliers, bunker fuel, not allowing Russian vessels call into their ports. How big of a logistics challenge is that? Also, obviously, the issue of the ruble structure or not ruble, buying in rubles, some of these structural impediments, even though there is no embargo as such.
Yes, the shipping sector is a relatively straightforward explanation. We have one large Russian shipping company, Sovcomflot, Sovchart, and they have been put on a sanctions list by various jurisdictions, and as such, people are a little bit hesitant or scared to supply them with bunkers or other services. So we will see that fleet out of circulation. That's the way it's heading. Of course, everything has a time lag in it. These sanctions don't take full effect after some time, and there are certain carve-outs to continue allowing European markets to be supplied because they can't get by without Russian energy. So if you take the big numbers, Russia exports about 7+ million barrels per day of both products, refined products and crude. And the figures I was giving you earlier is that maybe less than half of that is going to be shut in. So there are carve-outs, as Christian was alluding to before, for Europe to continue taking delivery of this. But yes, the shipping example is a pretty good one because you run into all sorts of issues, not just people providing fuel bunker suppliers, but also insurance companies and the banking sector, making it very difficult for people to effect payments to Russian shipping companies.
In Mike, when I'm not sure if you were in Lausanne last week or the week after, when the community of traders were meeting, and one of the big narratives coming out of that was access to credit lines, and that there would be some real sort of disruption of maybe more vulnerable trading houses and so forth. What are your views on that? And again, like shipping, is that a structural? Is that there was some fairly alarming comments coming out of Lausanne on that issue?
I wasn't there, but I did follow some of it post facto online. Yes, there is a general acceptance that sanctions, which will be observed by all in those jurisdictions where they apply, will result in people winding down activity as they must.
Let's go to the survey question and see where that's at vis-a-vis the room ultimately. What does the recovery of the ruble signal? We've only 2 options. I thought we had 4 options.
I see 4.
You see 4? Oh, good, because I only see 2. Maybe because I'm on. Oh, there they are. Sorry, got to scroll down. Good. So, I mean, I think this is an important point, because where this goes, I think, is at least how you interpret it. And obviously Christoph commented on his views on this, but ultimately what's driving it and what does it mean, I think is important from an economic impact point of view, because ultimately that's the only weapon the West have at the moment. Ultimately, of course, they're supplying weapons into the Ukrainian army, but the big powerful weapon they're using is sanctions. And if the ruble is an indicator or reflection of the health of the Russian economy, then maybe the 1 and 1 is 2, the sanctions aren't working. I don't know. That's my question. Maybe it's also because there's a peace deal coming. The Russians are supposedly pulling back from Kiev, which one had initially thought was the big prize they were going after early days in the war. Or was that always a ruse, a distraction for them to capture and essentially take all of the areas of Ukraine that border Russia? 3, pricing Russian energy in rubles. That seemed to be the turning point. The idea that exports would have to go into euro, rubles, none of the above. So please, your thoughts on which one of these is, what does the recovery of the ruble signal? And give us your thoughts on that. Christoph, with the bigger picture going into Q2 now, obviously we have this ongoing conflict in the Ukraine and the outcome with Russia. We also have the Fed supposedly now more or less all on board with a few more robust rate rises of 50 basis points. What do you look forward to? What is sort of, do you think, directs the market from here?
I mean, clearly, sort of one thing will be the military situation, and whether Ukraine, they have to do something if they don't want to lose these provinces. And maybe it was just an accident. Maybe it's a thing, harboring of things to come when they, for the first time, attacked Russia in Russia. So that could be a sort of inflammation which happens there, which is an escalation. Secondly, clearly, so we have to look at the economic development. It seems to be that the Fed has come to the conclusion that the American economy is recession-proof and will continue improving very rapidly. I'm not so sure if that and the energy prices sort of stop propelling inflation forward very quickly, then we may then see them, not going up all the way. If they are right and the inflation and the U.S. economy keeps accelerating growth, then this will not be the end of the interest rate increases, because then they really need to bring them up to the level where inflation is. That's the second one. China we already mentioned. I think these are the things. Then I would also look to what happens in Russia itself. So this is like this coloss which is now slipping out of everybody's. The danger is that they slip into economic insignificance. Again, this ruble thing is, we should not get excited about it, because it just means the ruble isn't traded. That they closed all the currency houses in Moscow. So if a currency is not being traded, it's easy to fix its value to something. And that's one of the.
Christoph, your thoughts Obviously, last week it seemed like the sort of deadline of April 1st on the pricing or paying for energy in rubles. Obviously, particularly Germany faced that as the biggest importer of energy from Russia, and it sort of has passed now at a slightly pushed deadline on it, but it still remains there. How do you see that playing out in the coming weeks, and how big a deal do you think it is?
This is either a bluff and nothing will happen other than protracted renegotiations, or it's yet another example of there being a layer of people below the man on the top in Russia who try to prevent the worst all the time. So Russia sort of threatened to default on its bond payments, and they didn't. They threatened to take away all the dividend payments, the GDRs, ADRs, the equity holdings from foreigners, and they didn't. They threaten now to, not deliver gas to countries who don't pay in ruble, and they didn't. Gas is still flowing. The German chancellor went out from a call with Putin and said, this will all be that they are trying to, basically he said, we don't have to pay in ruble, and they will fix it in such a way that everybody can save face. So it seems to me increasingly as if there is really sort of a layer of bureaucrats and more or less competent people who don't want to burn every single bridge. And as if some of these threats uttered in public, like this one, he said, it has to be paid in ruble next week. And I gave instructions to Gazprom and the central bank to do it, full stop. Now, 2 weeks later, still not being paid in ruble. So these are the first sort of little cracks appearing that there is some degree of sanity also on the other side, which needs to be exploited. This particular thing, I don't think that they use it as an excuse to stop gas deliveries, and if they're not willing to go that far, then the ruble payments will not happen. It makes no sense. It's just an annoyance.
Mike, your thoughts looking forward into the second quarter, into the coming weeks? Obviously, China is a big question mark on the demand side. Beyond COVID, there does also seem to be some real structural challenges there. The construction industry remains vulnerable, unresolved. Your thoughts on what might be bigger issues to watch going forward, and also welcome, you had commented, I remember a year or more ago, about when there was Iranian barrels leaking into the market, sanctioned barrels that were at a discount, that they were structurally dislocating the market a bit. If we see a lot of Russian oil in a similar place now going forward at such a big discount, how does that structurally impact the market?
Yeah, so much has been made about this. I mean, quick one on the ruble. I find it astonishing that the ruble is back to pretty much pre-invasion levels at 80 something to the dollar. Given the impact on the Russian economy, that just doesn't seem sustainable. But to your question, yes, I mean, that last point, allowing for carve-outs to Iranian sanctions, that has been done with the express input of the State Department, whereby a Chinese importer has the recognition that they won't be made subject to secondary sanctions or anything like that by continuing to buy a certain pre-agreed amount of Iranian oil. Over and above that, there is some leakage, which history of oil trading suggests is always the case in a world where sanctions apply. Now, the reason why there are sanctions on Russia are kind of different. I mean, Iran was sanctioned because of the concern over their nuclear ambitions and because of their sponsorship, allegedly, of state terror extraterritorially. Russia is being sanctioned for invading Ukraine. So I think the moral hazard argument, as we're putting it so much, is a global concern. And it's quite telling that Chinese buyers didn't step up to the plate, despite Beijing coming out the day after the invasion saying that it's business as usual with Russia. We haven't really seen particularly visible buying by China of Russian energy. Everyone's assuming it'll happen. Everyone's assuming there'll be a way found because there are no sanctions that prevent a Chinese energy consumer from procuring Russian supplies, provided they don't use the Western banking system or US dollars for payment. So everyone's
the Indians are doing it. The Indians are stepping in there.
And indeed, there's been various rapprochements there as well. Thanks. Yes. Sean, I missed your middle question now, which was
just about the outlook for China. The structural. Obviously, there's the COVID piece, which, as we've seen in most countries that have tried to tackle Omicron, it's a fool's gold, if you like. There's no way of Omicron not reaching its ultimate sort of outcome, which is spread everywhere.
Yes, I mean, you mentioned or Christoph mentioned the party congress in October. I think between now and then we're going to see China, and we have some anecdotal evidence on this already, put a massive effort into infrastructure spend and propping up of the economy in that very sector, which has caused the embarrassment to start with, the Evergrande, etc. I think you're going to see big outlay. We've yet to see signs of major road building programs, but we're expecting it. We're yet to see signs of major infrastructure programs, but we are expecting it. And in the meantime, you've got apparently 20,000 Shanghai financial workers sleeping under their desks to make sure they can keep the wheels of commerce turning in China's financial capital. So no, I think China will throw the kitchen sink at making sure the economy delivers, despite the fact that you had a slightly negative set of PMI data just last week. They're not going to allow that economy to slow down too harshly before October. And yes, I happen to be in the camp of people that thinks that China will continue to suppress this, because I have staff in China who tell me real time what's happening. I've got a few people in China, in Shanghai, they're all locked down, they've stocked up and they're going to go nowhere. And I've got a few staff that have been put on quarantine, and they get supplementary quarantine notices and they speak to the authorities, and having returned from Singapore and quarantined for 3 weeks, they were asked to top it up, and they dutifully do so. So I mean, yes, you're right, Sean, Omicron is likely to spread everywhere at some point in time, but the Chinese are certainly making a good fist of arresting it.
But with that, I suppose at the cost of oil demand, we have earlier this week the idea that that oil imports into China will decline for the second year in a row. Would you still challenge that thesis?
They had a lot of inventory which they built. They were quite astute at taking advantage of the pandemic and building stocks phenomenally during 2020. So yes, if you want to say 2022 is the second year in a row, 2021 was certainly going to be less imports than 2020 because of that phenomenal stock build.
Right.
So that one doesn't really count. I think the jury's still out on this year because we have a long, long way to go. So I would not necessarily agree that we're going to see that second year running by the end of this year when we look back. I personally think not.
Let's go to Christoph for the last word, get the survey result in, see what the view in the room is on this. Sanctions of ineffective is the sort of view in this room. Christoph, your thoughts sort of closing out, week ahead, where does this all go, do you think? What will you be watching? Fed are to come out with some of their notes this week, signaling where they might go with increased rate rises.
No, I mean, I would look at the American economy, whether it is all as strong as they think. I would have my doubts there. And then I would try even more than normally to decipher what's going on in China. Because as some people have been saying, this stimulus program there will not be more roads and more of the usual, maybe that too, but it will have to be a shift also into more consumption expenditures. And that will have even bigger implications, not just general energy, but for oil specifically than they normally had. And when this is going to come and how strong it's going to be is something which deserves much more attention than we had so far, I think. On energy markets also, what's still outstanding here is the sanction discussions, whether there is the political will and the coordination on this voluntary basis for more country blocks like the EU or individual countries to increase their moratoria against embargoes or whatever we want to call it, against importing Russian oil. And on the other side, there are still countries like India, so in particular, which I think deserve some more study to see how this Russian oil, which is now floating around these 2.5 million barrels it is finding new homes. And India seems to be in this game more important than China currently, at least. So these would be the major things, I think, other than the military situation.
Yes, clearly. Where does the military go vis-a-vis this withdrawal from Kiev? I think is one to watch in the coming days and weeks, perhaps. Let's wrap it up there and thank Mike Muller, as always, first Sunday of the month. Really great, Mike, to get your insights. I know these are difficult days for everybody, and obviously most particularly for the Ukrainians, but inevitably for anybody at the front end of the markets. Christoph, thank you so much as always for anchoring on Sunday, and we'll catch up with everybody every morning at 10:30 UAE time. All the best. Thank you.